Hi and welcome to Forager's June 2018 quarterly video series. I'm Nicole Colantoni and I'm here with Chief Investment Officer Steve Johnson. Hi Steve.
Hi Nicole, and thanks for hosting today. By the time you're watching this video, Alex will have had a newborn baby and be home looking after the baby, so great to have you on board.
Yes, indeed, and in her absence it's been busy times in the office this week. Both the June quarterly report and annual performance report hit the presses this week. So Steve, in your opinion, what is your overall impression of the 2018 financial year?
Yeah, it's a big time of year for us in terms of putting out reporting because we do the detailed performance report, and it's probably been a subpar year, to be fair. We've made money, and you should never complain about making money in the stock market, but both funds have fairly dramatically underperformed their respective indices. There's been a few external factors there. Value investing as a strategy has underperformed growth investing over the past year. We've held quite a bit of cash in both portfolios, and we've also had a self-inflicted wound or two in both of the funds.
Are you able to touch on some of those self-inflicted wounds? What exactly does that mean?
Yeah, a couple of stocks that we've picked that haven't performed well because of internal issues rather than anything external. The two big ones are really Thorn Group in the Australian fund. Its share price has halved over the past year. A combination of poor operational performance and a lot of regulatory crackdown. You might know that business. It's the owner of the radio rentals brand, and there's a lot of focus, and deservedly so, a lot of focus on provision of finance to low-income people, and that's the space that radio rentals operates in. It's also had a few management stuff-ups and a few things go wrong, and we're really pushing that company hard to try and change its strategy, but that hasn't stopped the share price falling by more than 50% over the course of the past year. And we've had a similarly dramatic fall, but we actually had a larger position in a company called Technicolor in the international fund. We've written a lot about this over the past year or so, so I won't rehash the arguments here. But again, a confluence of external events and internal stuff-ups that have caused the share price of that business to more than halve as well. So they were the two things that I think we got wrong that had a big impact on the portfolios.
And you said that value underperformed. What exactly do you mean by that?
Yeah, this has actually been a global phenomenon in stock markets around the world over the past few years, really. The stocks that are notionally cheap, i.e. trading at low price to earnings multiples and low price to book multiples, have tended to stay cheap. And the businesses that are in the growth category, i.e. they're growing their earnings and are darling stocks, have tended to go up and up. Now this has been applicable within markets, so we've seen it in Australia that the high growing businesses have been very well rewarded in terms of share price movements, but the value stocks haven't. We've also seen it in terms of entire markets. So the US, which is quite tech heavy, it has quite a few growing businesses, has seen its market dramatically outperform the UK and Europe. And we've put a few charts in the performance report explaining how that dynamic has unfolded. Look, generally for us, that is a less of a tailwind. It's our job to get out there and pick stocks, and we're allowed to own businesses that are growing quickly, so it's not an excuse, but it's certainly been a headwind for our performance over the past year.
Right, and so what does this mean for Forager moving forward?
Look, while that's been a difficult environment for the past year, it's actually created quite a few opportunities for us. You've seen the cash weighting in the international portfolio fall from about 30% this time last year down to 12 or 13% at the moment. So we've been able to put a lot of cash to work. We've actually been able to find some pretty good quality businesses, not growing like crazy, but good quality businesses in markets that people are pessimistic about, particularly the UK. We've got 4 of our top 5 holdings in the international fund are in the UK at the moment. So we've been able to add quite a few of those stocks to the portfolio and really reduce that cash weighting, which has me feeling a lot more optimistic about the opportunities that are ahead. The Aussie fund is still, I would say, in a period of transition. We've still been selling some very good performers in that portfolio over the past year, like ServiceStream, like Jumbo Interactive, and been replacing them with new opportunities that come along. We'd like that process to be a bit quicker than it has been, but it has been unfolding. I think the other really important thing for investors in our business is what's been going on underneath the surface at Forager, and we've had a really good year on the recruitment front. We've had Alex Chevalev now working hard on the Aussie portfolio for more than a year and starting to really have an impact there. A couple of new analysts have joined the team as well, and we're really happy with the way that the team is working together and the number of opportunities that we are finding.
Well, thanks for your time, Steve. In the next video, I'll be chatting with Gareth Brown about a Norwegian stock in the international funds.